Porsche, the iconic German sports car maker's stock, has plummeted more than 60% since its 2023 peak valuation. The company recorded an operating loss of €966 million in the third quarter of 2025, compared to a €974 million profit during the same period last year. This shocking reversal marks a significant crisis for the luxury automaker. The company's financial situation has deteriorated rapidly, with group operating profit plummeting to just €40 million in the first 9 months of 2025, down from €4 billion in the previous year. This represents a shocking 99% decline in profitability. From weaker overall electric vehicle demand to China's luxury market slump and tariff hikes from the US, we will explore why Porsche is struggling. Porsche's electric ambitions have faced substantial setbacks as the company admitted to postponing several all-electric vehicle launches. The company explicitly cited delayed ramp-up of electric mobility as a key factor behind its strategy shift. This acknowledgement came after Taycan deliveries fell by 6% in the first half of 2025, signaling weakening demand in the luxury EV segment. In particular, the development of a planned new platform for electric vehicles slated for the 2030s has been rescheduled and technologically redesigned in coordination with other Volkswagen Group brands. Perhaps the most costly strategic reversal was Porsche's decision to abandon its in-house battery production plans. The company explicitly stated, for volume reasons and a lack of economies of scale, Porsche is no longer pursuing its own production of battery cells. This dramatic shift came after Porsche had already invested heavily in its Cellforce subsidiary. The financial impact was severe. Porsche acknowledged that scrapping these plans contributed to a €1.8 billion hole in its operating profit. This strategic U-turn also involved cancelling a startup factory in Kirchentell-in-Fürth that was supposed to produce about 1 gigawatt-hour of batteries annually. In a remarkable reversal, Porsche has pivoted back toward internal combustion engines across its product lineup. Notably, the company's upcoming flagship SUV, originally planned as fully electric, will now launch with combustion and plug-in hybrid powertrains instead. Similarly, range-topping versions of the next-generation 718 Cayman and Boxster will offer combustion engines despite initially being designed as exclusively electric vehicles. Additionally, Porsche extended the production period of current combustion engine models, including the Panamera, well into the 2030s. The implementation of heightened US import tariffs has struck Porsche particularly hard. The United States remains one of Porsche's most crucial markets, accounting for approximately 25% of its global sales. However, the introduction of new tariffs on European luxury vehicles has significantly increased the cost of importing Porsche vehicles into the American market. These tariffs, which increased from 2.5% to 25% on certain European vehicles, have forced Porsche to either absorb the costs, further eroding profit margins, or pass them on to consumers, subsequently dampening demand. Financial analysts estimate that these tariffs have cost Porsche roughly €430 million in lost profits throughout 2025 alone. Simultaneously, Porsche has faced serious challenges in the Chinese market, historically a key driver of growth. China's luxury car market has experienced an unprecedented contraction, with overall luxury vehicle sales declining by 18% in the first 3 quarters of 2025. For Porsche specifically, this has translated to a 22% year-over-year drop in deliveries to the Chinese market. This decline comes at a particularly inopportune moment, as the company had previously invested heavily in expanding its Chinese dealership network and marketing presence. The economic slowdown in China, coupled with changing consumer preferences and increasing competition from a domestic luxury electric vehicle brands has undercut what was once Porsche's fastest growing market. Porsche's financial troubles became glaringly apparent when the company announced its third quarter results. The staggering €966 million operating loss reflects a profound reversal from previous performance. This financial downturn stems primarily from several extraordinary expenses, including a €2.5 billion write-down related to battery production plans and a €600 million restructuring charge. Additionally, the automaker faced increased manufacturing costs and declining sales volumes that further strained its balance sheet. Rising inflation rates across major economies have reduced disposable income for potential luxury car buyers. Additionally, fluctuating exchange rates have complicated Porsche's financial planning and further squeezed margins on international sales. Interest rates have also climbed steadily throughout 2025, making financing options less attractive for consumers considering high-ticket purchases like Porsche vehicles. This economic uncertainty has prompted many potential customers to delay luxury purchases, creating a challenging sales environment across all of Porsche's major markets. Amid mounting challenges, Porsche has initiated a leadership overhaul and comprehensive restructuring plan. Oliver Blume's controversial dual role as CEO of both Porsche and Volkswagen has finally come to a resolution. After a decade leading Porsche, Blume will hand over the reins to Michael Leiters on January 1st, 2026. In response to financial pressures, Porsche plans to eliminate approximately 1,900 jobs by 2029, alongside not renewing contracts for about 2,000 temporary workers. This represents a 15% workforce reduction at its Zuffenhausen and Weissach facilities. So I hope you guys enjoy this video. Leave your thoughts in the comments section below. Hit the subscribe button and like this video for more such content.